Hi, everyone, and welcome to another installment of Coinbase Institutional Presents On the Record with me, John D'Agostino. We're here today with Martin Green, the CEO of Cambrian Asset Management. Martin, thank you so much for coming.
Thanks for having me.
Now, you are on record as saying the industry, I'm presuming the crypto industry, liquid token crypto industry, is heavily long beta. Mm-hmm. So define that for us and tell us, what does that mean? Is that a risk? Is that an opportunity?
It's a risk and an opportunity,
okay.
as you would imagine. So what I mean by that is between the ETF launches, the digital asset treasury companies, and the amount of capital that's been invested into and by crypto VC firms, you're looking at probably $30 that's essentially long beta for every dollar that's risk managed in crypto.
Okay,
yeah,
so
that's
is it active versus passive? Is that the distinction?
Yeah, yeah.
Do you consider DATs to be active or managed, active or passive?
Well, that's a good question. Some of them are more active than others, but generally speaking, those are going to be passive.
Okay. So we have this flood of passive capital,
like ETFs.
Right? Overall good for the industry.
Yeah.
But as you and I were discussing before the cameras rolled on, that changes the dynamic of how markets behave.
Yeah.
So in theory, we should be seeing much less volatility. Right, that's the theory.
Because you haven't bid.
Now we haven't.
Yeah.
Overall, I think it's getting less volatile over time, but we still have these periodic episodes. Is that we're just too early in the timeline? We need more passive capital. Like what's happening there in your view?
Well, I don't think anybody in the crypto industry is going to suggest that we don't need more passive capital. We would always welcome more passive capital.
Sure.
The asset class should be more widely owned. I think generally speaking. But I think it's a risks build up, as you know, and your listeners know, in markets when there's structural kind of imbalances or people are getting to be overly enthusiastic or they're overly confident that their risks have abated. And I think you start, with the ETFs, the digital asset treasury companies, I think you're starting to see the signs of some of that. And I think we saw a mini version of that unwinding in the beginning of October 10th, when there was some leverage that had built up in the system that got flushed out.
So you're making me think of early lessons I learned in the commodities markets, where I learned the difference between market breadth and depth. And market depth being there's the notional liquidity in the market, but market breadth being the diversity of participant. And you'd said it, and now you're making me think that maybe this first wave of retail and institutional onboarding has been a certain type of investor. And that's why we're still seeing some of these volatility. But to your point, as that expands, and we have different investors coming in for different reasons with different risk tolerances, maybe then we'll see that abatement of volatility.
Yeah, that's a good point. I think generally speaking, the investors in crypto in any of the vehicles have been very risk seeking. What they've done is they've said they haven't quite figured out how to parameterize the different risks. They know it exists. So counterparty risk or liquidity risk or volatility or selection risk, asset selection risk. So they've bounded the amount of capital they've put into the asset class by some amount that they can kind of write off. I think that's an oversimplification, but I don't think it's too bad.
I don't think that's wrong at all.
And then the capital that they are allocating, if it's 1%, 5% or less, or whatever it is, to the space, they've wanted it to be very risk-seeking for the maximum bang for the buck that they have allocated to crypto.
So maybe over time we'll see people engaging in the market to hold a different place in their portfolio.
Right. I think over time, especially with institutions that are now feeling like they can look at the asset class as an asset class, and it's not sort of outside of their compliance framework or how they would do operational due diligence, but institutions who approach it from the perspective of this is just a set of assets and there are managers, there's passive alternatives. We should be able to just parameterize the risk. If you can parameterize the risk, and I think increasingly people are feeling that they can do that, and some of the longevity of the active managers allows them to look at that, then we might see capital that's looking for a particular risk-adjusted return or some characteristics that they can find as opposed to, I don't know what the risks are. It all could go to zero. I'm just going to put the small amount to work.
That lottery ticket type placing in the last portfolio.
Exactly.
So we talked a little bit about the role that this asset class might play in a typical early stage investor, this risk-seeking investor. Do institutions think of it that way? How do they think about risk relative to their entering into this market?
So an institution, the way you would probably be defining an institution, which is an agency investing model, a CIO that's looking at a pool of capital for the long term on behalf of an endowment or a pension fund or something like that, is going to look at crypto a little bit differently. And they're going to be able to identify the sources of risk, parameterize them as I would characterize them, and conduct investment and operational due diligence to assess their view of those risks. I think that's fundamentally different than the other capital that historically has come into the space. So this new capital that we're starting to see again, because it started to do research and then it went away and then it's back again to do some of this work in the space.
Perhaps in some way driven by the unprecedented success of the crypto ETFs, particularly the Bitcoin ETF, which the single most successful ETF launch of all time. I believe the most profitable ETF in the BlackRock stable of myriad ETFs. Right? I believe so. If not very close. So it's easy for us to in crypto who believed in this all along to look back to, well, obviously this was clearly always going to be, but let's face it, I think this is beyond anyone's expectation. What do you ascribe the enormous success of the crypto ETFs to?
Well, I think that the simplest answer is that they arrived at a time where there was a pent-up demand for a return stream that could potentially beat high growth equities in a vehicle that was completely compliant and within the operating frameworks of many
with the brand name to brand names.
Yeah, that's absolutely also true.
And by the way, we should give credit to the other firms like Bitwise and others that put the hard work in and have done incredibly well.
Yeah,
but certainly it helped. The BlackRock's name behind that.
It was basically there's a chance for great return, and there's basically no risk other than volatility.
Right.
And so I think many investors, individual and others, looked at that and said, well, we'd always had all of these other things that we had to check the box, and now, this made it an easy.
Yeah, easy being the major word there. Right?
Convenient.
And it's easier for. Sorry, please.
And it made me think of something. So it's now within the portfolio of an equity, so you can use it as collateral if you're doing, if you're borrowing against your portfolio, or it's consolidated in the reports. It just became easy,
and it doesn't require a buyer to learn a new system. I think sometimes that's one of our flaws in the sector. We believe that people wake up thinking about their money more than they do, and perhaps they should. But I think about it this way: I'm in a family of iPhone users, and I'm an Android outcast.
Congratulations!
And I'm fairly technical. I think I'm a decently intelligent guy. I have no interest in learning iPhone. I could. I absolutely refuse to. There's other things I want to do with my time. And I think about that when we are saying, are we going to expect someone with a vibrant life, a job, hobbies, family, to relearn how to engage with money? Probably more likely that they'll accept it if we fit it into their current way of doing things, as opposed to causing them to rethink that entire engagement.
Certainly, that's how you would achieve scale. That's not necessarily how you would create a breakthrough, and you may have to go outside of the what's.
Well, baby steps. Give them a reason to learn. Martin, we talked about the value of these assets in a portfolio. I believe in the context of just the market value. There's an increasing interest in yield generation from everything from Bitcoin down to other tokens. Do you believe that yield generation changes the role or the value of these assets within a portfolio?
In general, not materially, because the yield is a small fraction of the overall compared to the volatility of the asset and the expected return of the asset. So to oversimplify, I'm making numbers up.
Sure.
You have an asset with a 50% annualized volatility and a 50% hoped for return, and the yield is some very, very small fraction of that, the expected yield. And so how material is it? Should we be focused on it compared to the expected return and the volatility? And specifically, what is the risk we're taking with the asset? What is the risk we're taking in looking for yield? Are we properly assessing both of them independently? Oftentimes, I don't think we are.
Very fair point. Very fair point. Hadn't thought about the risk adjusted factor of generating that yield. But let me just play devil's advocate for a second more. So let's just look at an asset like Bitcoin, and maybe you don't subscribe to the Bitcoin as digital gold thesis, but certainly if gold had been a yield producing asset for the last 1,000 years, well, even 2% compounded over 1,000 years is a hell of a lot of money.
Wonderful.
Gold actually has a negative carry rate because you have to store it and cost money. So just play devil's advocate. If Bitcoin is going to be, if one thing Bitcoin can be, maybe not the only thing, is digital gold, accretive, maybe not replacing to gold, and it could produce yield. Maybe we won't have to wait 1,000 years for Bitcoin to be the standard.
I think that's the most compelling argument I've heard. I think that's a
change your
very
mind?
compelling argument.
A little bit.
Yeah, quite possibly. I mean, the question is, where is the yield coming from?
Sure.
What risks are we taking to assume those risks?
Right. Do we even know them?
I hearken back to 2021 when someone in my network, I won't name them, but they managed billions of dollars in a hedge fund. Before basically retiring. They're a very sophisticated financial investor. And the call was, why are we not pushing our Bitcoin, the Bitcoin we might be holding to trade, why are we not lending it out to a whole bunch of players? And because we could earn 3-4% or 6%, I was told.
Right.
And two things. We were borrowing to short at 3%.
Okay.
From these entities on a non-collateralized basis. And these entities no longer exist because they went out of business.
Right.
And some people in some of these lost their entire principal in order to get paid
3%.
3 or
so therefore, by
5,
definition, 4, 5, 6 is going to be riskier than that.
Yes.
You lost to the 3. I get it.
So
I get it. Yeah.
If where is the yield coming from? If that risk is properly assessed. If it's properly bounded. If it's properly understood, I'm all for it.
Right.
But
and to your point, I can tell you the delta on spreads on yields is so wide that it's clear that there are people taking enormous. To your point, like I think Coinbase Asset Management has a yield program. I think it offers like medium single digits. But then I'll hear say, well, that's fine, but I got this guy offering 30% a month. And I'm like, well, okay, like understand what you're getting.
Run away from
30%, right? Run away, exactly. Too good to be true. Fair enough, Martin. This has been wonderful. Before we go, I got to ask, what are you most excited about for 2026?
I think that the breadth of things that we can trade as an investment firm is increasing. The ability to do that with folks like yourselves, and to be able to not just trade spot, but trade other instruments, options, other derivative products around these to manage risk and to cross margin and settle and do all of the things that you would want to do that we would have wanted to do together, 5 or 10 years ago. It's on the horizon. So I'm excited about that. being realized.
And we're excited to have clients like you to do those things with. Thank you so much. It was really great. Appreciate it, Mark. Take care.
Thank you.